This is John.
I have a nuanced take on GP commit.
This is also John.
I think people use GP commit as a proxy for alignment. And I think a lot of emerging managers don't have the capital to put up meaningful GP, commit. And their alignment is just the fact that they're doing this and playing for carry.
Superclusters is where we demystify the secrets, stories, and tactics behind the money that moves the venture capital world.
Welcome back. Today we are lucky to have another world-class talent from the Allocate team. And for those looking for a deeper dive on Allocate, I would highly recommend checking out episode 8 from season 1 with Samir Kaji, but not to bury the lead here. Today we have the one, the only John Felix. John Felix is the head of emerging managers at Allocate, the operating system for private market investments where he invests in the next generation of VC managers as well as directly into transformative companies. John broke into the metaphoric LP catcher's mitt back at Washington University of St. Louis Endowment, where he worked with 3 different CIOs, Chief Investment Officers. And yes, I promise we'll get into that later in this conversation. Since then, he's marinated in the world of endowments at both Edgehill Endowment Partners and Bowdoin College. Outside of Allocate, he's about to put a ring on it, as well as an avid New York Giants fan, a bird watcher, a guitarist, among much more. We cover a lot of ground here, but some of the standout kind of material that I've personally been very fascinated by in this conversation include 1, the art of the cold email, as spoken from John. 2, the tightrope balance between over and under diligencing emerging managers and how do you walk that? And finally, as I mentioned earlier, what's it like working between 3 different CIOs who have 3 different strategies, at least from the endowment perspective? We get into the weeds, but without further ado, John, welcome to the show.
Thanks for having me. Excited to be here.
Oh my God, I told you this in the pre-chat, and I had so much fun doing homework for this conversation, and things will come out as, not to play too much suspense here, but things will come out. But if it's all right with you, I'd love to start this conversation off with the quintessentials. And so I'm curious, what made the quintessentials a special and significant chapter in your life?
So I love talking about this period of my life because the quintessentials was really a formative experience for me growing up. And for those listening who don't know, the quintessentials was a 5-piece band that I played in, during high school and then into college. And we played mostly cover music for classic rock and jazz and blues. We'd play at parties and different events around town. For me, I played sports most of my life, but the sports that I tended to gravitate towards were things like tennis and snowboarding and golf, individual sports. And so, I played baseball, I played basketball a little bit, but none of them ever really stuck. And so for me, the quintessentials was kind of my quintessential team sport experience. And it was an environment in which I learned to, collaborate with others, to improvise, to play off other people's strengths and weaknesses. And so we played together for all throughout high school and into college, about 5 years. Some of the folks that I played with ended up going on to become professional musicians. They're much more talented than I am. I obviously didn't, although I still do play guitar. But I think, one of the things that really helped me, and still to this day, is when you're playing music, and especially the type of music that we were playing, which had a lot of improvisation to it, right? We would play jazz where we'd solo all the time. We'd play classic rock where we trade back and forth soloing. You never know what the other person that maybe you're trading solos with is going to play. But if you play together long enough, you form trust and you start to form pattern recognition and you start to kind of know what the other person does and what they tend to do. And so it forms this trust that allows you to play off each other. And I think it's very akin to working on teams today, where, you spend time working with people, you start to realize how they work, how they function. You start to almost become predictive in what they're going to do, which allows you to become, more proactive and efficient. And I think that some of the dynamics that I learned and saw when I was playing in the quintessentials as the lead guitarist, I still use some of those frameworks today when I'm looking at teams, to evaluate from a management perspective, right? And I see you pick up on how people interact, and I'll be looking at 2 folks on the team, maybe going back and forth, trading answers to a question that I ask them. And it kind of reminds me of, when I was playing in the Quintessentials, trading solos back and forth with our pianist, for example. And you start to see and pick up on little things on how people work together, how they play off each other. You pick up on different dynamics. And so I think, the Quintessentials for me was really a formative kind of experience as I was growing up. And I think really has helped me become a better investor today.
I have a lot of questions there. I want to bookmark something first, which is first, like you mentioned in playing on the Quintessentials, you built frameworks for how to work on teams. See that in your mind now. I'm not going to ask the question now, but the question I want to ask is, how did you first meet? Were you all in band class together, or like marching band together? And you're like, hey, you know what? We all happen to be playing in, different instruments. Let's get together. Actually, now that I think about it, I don't think there's a guitar in band. Or I might be wrong there. It's been a while since I've been in it.
I went to public high school in Westchester County outside New York, and we were fortunate that we had an incredible music program. Mr. Corio, who was the head of our music program, had been with the school for, I think, something like 30 years, and he actually ended up retiring shortly after we graduated. But he had this incredible music program for a public school, and in addition to the core like orchestra and band program, there was a really strong jazz program. And so, as a guitarist, I was actually able to participate in that program through school rather than having to only take lessons outside of school, which I still did. I took lessons outside of school, but and so when I was going to high school, I actually was kind of in transitioning. I was transitioning between friend groups, and I didn't have a great friend group in middle school that I carried over to high school, and I was lucky enough through this music program to meet my friends who became the Quintessentials. And so a lot of us initially met through the band program, and then became friends kind of outside of school through that. And then over time, we kind of really formed it around the five of us. And so there were three of us at first who really started playing together a lot. It was myself, a drummer, and kind of a singer bassist. And then we ended up ultimately adding a piano player who's now a professional piano player. And we ended up kind of adding another multi-musician. And so the thing about us was many of us played multiple musicians also. And so we would sometimes swap out. And so I would play piano on some songs. Our drummer would sometimes play guitar on some songs. We'd all trade off singing. But I think the way that we came together, which was pretty organically, and because of a shared just passion and love for music, made it such that we played organically together. And it came off, like everything we did came off as so organic, and we built that trust over time. And it was an amazing experience.
This is a topic I've been thinking a lot about, largely because of recent conversations. I don't want to draw the parallel. Yeah, I still want to stay on the center of the story. But the reason I'm even suggesting this question is because there are a lot of fund ones that I'm talking to that have we're solo GPs who have added on kind of a new GP for fund two. So like now it's a team of GPs rather than the solo GP. And the reason I ask that is you mentioned that your multi-musician as well as your piano player came in after your first three started working together. How did you find that pianist and multi-musician? How did the conversation end up going? Like, were you looking for a pianist, and that's why you're like, hey, you know what? We just need someone to fill this void of decibels, so to speak.
It's funny. So I actually think back on the earliest days of the Quintessentials before we even had a name. The first time like any iteration of the group played together was I think it was a talent show that we were that the school put on every year. It was the first time I had ever played music in front of a crowd. And it was the core for initial three of us, but then we had two girls that we were friends with who actually sang in the school's chorus. We just kind of, I think we actually put up flyers around school looking for a vocalist. And so the two of them responded and were like, hey, we both want to do this. And so we rehearsed a couple songs with them and we played on the talent show. And ultimately we realized that like they probably weren't the best sound for us. They were both really talented vocalists, but we were looking for like a little more of like a traditional rock, classic rock kind of vocalist. And so we ended up getting connected to our piano player because he actually played saxophone in the school band. Uh-huh. And he didn't play piano a ton, or he played piano a ton outside of school, but not within the context of school. But somehow we kind of found out that he played piano. He ended up being an incredible piano player, much better piano player than he was a saxophone player. And he was a good saxophone player. But we all started kind of just jamming together, and then our other friend who was kind of a multi instrumentalist ended up saying, "Hey, I'd love to jam with you guys too." And so we ended up just going to the band room at school in between classes and playing together. And we realized that, hey, this works. Like the five of us sound really good together. And I don't think it was because we sought out any specific person or gap. Like we kind of generally knew what we wanted to sound like. But when we all started playing together, it just clicked, and like we just knew. We were like, this is it. Like this is the five of us. We're going to do something here.
Was there something that served as inspiration for when you thought you wanted to sound like in a certain way?
It's a really good question. I mean, growing up, the bands I idolized were folks like Led Zeppelin, Pink Floyd, The Who. U2 was a big inspiration at the time, and funny enough, the way U2 came together was they were all, a bunch of them were in high school together in Ireland. And I can't remember if it was the guitarist, the Edge, or the main singer Bono, but one of them had put up flyers around their school, like I think it was like vocalist seeks, musicians to form a band with, something very basic like that, right? And and funny enough, the initial three of us that came together, we were all big U2 fans. And we said, let's do that. Let's put up flyers around school and see what happens. And, it was a little embarrassing at the time. We didn't know what people would think, but it ended up working. And so I would say like that was kind of the inspiration of the method of attack that we used to find the other folks. But it was all those bands that were those powerhouse rock, bands that had the bass player, they had a keyboard player, they had, an amazing drummer, they had the lead guitarist, and they had the vocalist. And like for us, a 5-piece band always kind of sounded right.
And was there a goal in mind when you guys formed the Quintessentials? Or I guess in the beginning, probably like Three Musketeers and eventually like the Quintessentials. Did you have a goal in the sense like we want to perform collectively together at the talent show, the school talent show, or we wanted to participate in competitions or go against other schools? Was there a vision in mind?
No, it's never about competition or about achieving anything. It was all about like just coming together around this shared passion. We all love music. And just playing music together. Like there's, we would play in our basement all the time for nobody. We one time recreated the Beatles have this famous rooftop concert they did. We effectively recreated that on the rooftop balcony of my house, and we played a concert there for nobody, just for fun because we wanted to. And so like for us, it was never about necessarily achieving anything or like winning anything. It was just about coming together with folks that shared, and have the shared appreciation and passion for music, and just being able to play that music, and when you play music with people who also love to play music, and when you all, sound good together, like there's just nothing better. And that personal reward that you get from then, going back and listening to the music that you played is just, it's an incredible feeling.
Amazing. I want to go back to the folded corner of the page that I seeded in our minds earlier, which is the framework of being on teams, right? Like things that you learned in being together with the Quintessentials, like how you've applied them to today effectively. What were some things you learned? Struggles, disagreements, ways to find like just passionate individuals that you carry on till today for your work today?
Yeah, it's a really good question, and there's a few things I'll call out. So the first one is, we were all friends outside of playing music together. So we would hang out outside of rehearsals, and we weren't performing. And I think that's critical because we all had empathy for each other. We had trust for each other, not only as bandmates but as friends. And that trust, in the personal sphere, carried over to trust when we were performing together. And I think when I think about being on a team today, yes, of course, we work together. I work with my colleagues in a professional setting, but when you spend time to actually get to know your colleagues, to learn what motivates them, to learn what their passions are outside of work, it forms a different level of trust that translates into the workplace. And that trust makes you better colleagues. It makes you more efficient together. When you're collaborating on things, you don't have to micromanage each other because you have that trust. And for us, in the Quintessentials performing, like things always went wrong, right? Every gig we played, something would go wrong. Either, we'd get there and we'd blow a fuse because we were plugging in all our, high voltage amps into the same electrical outlet. We would, there was one place where like the sound just sounded terrible. There's another where we played this gig in New York City once, and We were supposed to go on at 8 p.m. and we ended up going on at like 10:30 because like we were playing at this gala and it just went, like you just, but effectively, like you always have to plan for some wrench to come thrown into your plan. And so I think having gone through all of that, it makes you more nimble and it makes you, be able to react more quickly and appropriately to kind of these challenges. And so we saw every problem you could have imagined as a band playing all these, different gigs with probably not a lot of technology. And I think that that reactiveness, you're always on your toes. That's translated to I think me and some of my values in the workforce today.
And speaking of being on your toes and going back to the Mike Tyson quote, everyone has a plan until they get punched in the face, or is it mouth? One of them.
Yeah.
either way it hurts, right? How do you prepare for such blows and how do you react quickly to that?
So it's a really good question. So you always, Mike Tyson was definitely right that you always have to have a plan, but you can't be so specific about your plan that it leaves no room for change or for error. And so what I mean by that is we would always have a set list going into a gig that we would play, but that set list would almost always change midway through the show because we'd get feedback from the audience or like maybe their energy was a little lower. And so we needed to, pull a high energy song forward to kind of hype them up. Or maybe we were expecting the guitarist to set up on one end of the stage because they're away from the drum set, but then for whatever reason there's no room over there, so you have to set up on the other side, and then you have to change away, the way your amps are kind of set up. And so it's always good to have a plan, but your execution cannot be tied to following that plan 100%. You have to be able to execute, knowing that like the plan's going to change, right? And so we always leave room to adapt, to change, to be nimble, and I think that's critical, especially today.
This is fascinating to me. What it reminds me of is I literally had a conversation earlier today. Give her a shout out because I love her. Erica Wenger at Park Rangers Capital.
Yeah.
She is by far more of a seasoned podcaster than I am, but and I was asking her for tips, to be completely honest, earlier today. And then she said something that was like really interesting from the content creation angle, which I think one of her mentors once told her this, or maybe it's original. Erica, I'm sorry if the attribution is wrong, but it was in the context of you do all your spend a lot of time preparing for the interview, do all your homework, do all your research necessary. But once you actually jump in the interview, you ask the first question and then you throw away every other question, because then you kind of just let it take hold, right? Because you can set the stake in the ground, and where the wind's going to blow after that, the flags the flags will tell you, right? Which I found to be very, very interesting, which I'm also realizing now. I sent you a list of questions and we're slightly deviating off course as well.
No, that's all right. It's a good point. Like, I do a lot. I speak on panels and I do webinars and things like that. And when I'm preparing, personally for all those things, I always have a general idea of what I'm going to kind of talk about, but I never write it down, and I never write down like full phrases or thoughts or sentences. And some people do. That's never worked for me, because for me, if I rehearse too much what I'm going to say and I miss one word, then it's going to throw me off and I'm not going to know where to go next. And it's kind of similar to soloing. If I rehearse a solo note for note before I do it, and then I miss one note, I'm going to freak out and be like, oh my God, I missed that one note. What's next? I don't know what to do. And that way, like if you actually leave room for true improvisation, there's never a next right note or a next right word to say. And you kind of just go wherever it feels naturally to go next.
Thank you for playing my sparring partner over here. I want to take a little... sorry, a little walk kind of like down the John Felix timeline. You're marking to around the time when kind of you found yourself graduating from college, which I always find very interesting, because you found yourself straight into the endowment world. And most people, I mean, there's no undergraduate class of like, here's how to be a capital allocator, work in an endowment kind of thing. But you found yourself very much in that world, almost not haphazardly, but almost accidentally, as a function of strategies changing when you were at, I want to say it was like Blue Ridge Capital.
So I had been lucky enough to intern at Blue Ridge Capital all throughout college. And for those of you who don't know, Blue Ridge was a really successful Tiger Cub hedge fund, about $8 billion fund at the time, or at its peak, long short equity hedge fund. And I interned on the trading desk there all throughout college. For every summer, I would intern there. I would go back in the winters and spend a month working there in between semesters. And I, there was part of my life where I really thought I would go work there as a trader, or as, something on the trading desk after college. By the time I was graduating, Blue Ridge was kind of already starting to transition into a family office. And so I all of a sudden found myself effectively having to look for a job. And because I did not do the, junior year internship in banking or consulting, I was kind of starting down 0-2 in the count. And I had been lucky enough, I had actually walked into our career center with, a couple months maybe left in college for probably the first time ever walking into the career center. And I was like, guys, I don't have a job. I'm graduating in a couple months. What am I going to do? I had studied finance and I'd gone to, through our undergraduate business program at WashU. And I was fortunate enough that at the time that I walked into the career center, the endowment for WashU was actually hiring. They were looking for an analyst. And they had just created this new kind of 2-year analyst program. There was one class before me, but it was all master's students who had joined. And so I actually interviewed with them, and they hired me as the first ever undergraduate hire for the endowment. And it was a really interesting experience because, to your point, I had studied business. I was in the business school at WashU. I thought I knew a lot about investing. In hindsight, I knew almost nothing about investing, but they never teach you about this world of capital allocators. I think a lot of the coursework I had that related to investing was related to stock picking, right? Like direct investing or private equity or something like that.
Yeah.
But very quickly I thought, wow, this sounds really interesting. It's kind of a multidisciplinary role. You get to see, you get to work with a big pool of capital and invest across all these interesting things. And so I kind of took a chance on it, and it ended up being a great launching pad for my career.
That's amazing. And thanks for setting up my next question as well. So we're now at a period in time where you're at WashU, and while you're at WashU, you went through, as I mentioned, kind of to fulfill a promise to our audience here, but you went through 3 different CIOs, chief investment officers. What was that like? And did any of their tenures influence the way you think about underwriting investments today?
Yeah, it's a really good question. So the rough timeline was I joined right after I graduated in summer of 2016, and Kim Walker, who had been the longtime chief investment officer of WashU, she was leading the team when I joined. And then that fall, so somewhere around 6 months after I joined, she announced that she was retiring. She had been there for, I think, around a decade, maybe a little more. And so, and I, she was part of the reason I joined initially because, she had, I was just really impressed with her. So I was disappointed to see her leave, but very quickly, one of our board members, Eric Upin, stepped in as kind of an interim CIO role. And this was my first true professional experience. Like, I had no idea what was going on. But I looked up Eric and his background, and I was like, oh, this guy's legit. Eric was, he at one point served as the chief investment officer for Stanford's endowment. He also had co-founded a very successful firm called McKenna Capital, and now has gone on to found another successful firm. But Eric came in and really was interim CIO for about a year. And it took that long to find the right person to take over as the full-time job. And I think part of the reason why was WashU has a very, very, very long-term time horizon. And not only how they think about investing, but how they think about building the team and strategic goals. And so I think Eric and his team knew that if we take a little longer, even if it takes a year, but we find the right person who can steward this pool of capital for 10, maybe 20 years, it'll be worth it 10 times over. And so, during that year, Eric, I'd say, made sure the trains kind of ran on time, kept the trains running on the tracks. He didn't do anything earth-shattering in terms of portfolio, but I think he was self-aware. He knew that wasn't his job. But he really led a search to find the right person, which was Scott Wilson, who joined from Grinnell College. And even though, so I joined during this analyst program, it was a 2-year program. So by the time Scott joined, I was kind of already starting to transition out. I had my next offer, but Scott and I overlapped for, I don't know, it was maybe like 5 or 6 months or something like that. And in that time, he turned over something like a third of the endowment in just those few short months that we overlapped. And I would say, even though my time with Scott was the shortest, a lot of his investment philosophies and frameworks still to this day influence the way I think about, being an allocator. And Scott is very contrarian. He's very, he doesn't care what other people think. For those of you, listening who don't know, WashU has a very different approach than most endowments out there. They invest in a very concentrated way with managers. They do a lot of direct investing. They'll take some very big swings and concentrated bets. And it's paid off even in the short amount of time that he's been. Well, I guess it's been maybe about 6 or 7 years since he's been there, but it's paid off. And WashU's endowment has done tremendously well. And I think the fact that he was willing to not do what everybody else was doing and kind of iterate on the endowment model to do something different, it's just a testament to independent thinking, not following the crowd, but also having conviction and taking big swings when you have that conviction.
If we could make it a little bit more concrete, you mentioned concentrated portfolio. First of all, can we compare and contrast that with how, in your experience, endowments typically operate? And then the second part of this is, when you say concentrated, give or take, you can say a range. Is that 10 to 15 funds in which you're investing in, or is it even less than that?
So I think, look, a lot of endowments say that they like concentration, both in terms of number of line items, on the for the total endowment, but also in terms of portfolios for each of those managers. I think in reality, manager proliferation happens at almost every institution, and part of that is because, if a CIO is there for long enough, there's re-ups, they like to do new things every year. It gets really hard to fire existing managers. And so you end up just adding new managers. And so what we did, the first exercise we did when Scott joined, was every asset class team force ranked every single manager in their portfolio. And it was a forcing mechanism. It's you can't cop out and say oh, well, these are our three favorite. It's no, you have to rank them 1 to 3. And by the way, you have to rank every single manager 1 to, however many managers are, right? And so
gotcha.
That ruthless
to interject
force,
here, is this also let's say it's a team of 2 managers, are you ranking them separately, or are they just a single institution?
Well, so I guess what I meant is for example, the public equity team ranked all of their public equity managers, force ranking. The private equity team ranked all of theirs independently. And so each asset class had its own force ranking. Gotcha. But the idea was that if a manager wasn't your top, 5 or top 10 idea, why is it in the portfolio? Right. And so what we did then is we looked at that and it almost forced you to say hey, you rank this manager number 20 out of 20. Why haven't you fired them by now? Right? Why haven't you redeemed your capital? Right. And so we ended up culling the manager roster meaningfully and concentrating capital either into the top existing ideas or in some cases adding a couple, new managers.
Let's say you decide someone ranks 20 out of 20. How do you have that conversation with the manager? Or do you kind of just expect the manager will follow up the next time they fundraise and you're unfortunately, we can't invest in you? Or is there a proactive, preemptive communication tool you use to tell the managers hey, you know what? We're likely not going to re-up in you for the next fund? There's
the proactive communication, which I think we did in some cases and which I'm a fan of because, look, I think at the end of the day, the real managers that have integrity, they would do the same for their portfolio, right? If one of their companies was raising a follow-on round, they didn't think it was a good investment, they wouldn't invest. And so if you kind of be proactive with that communication, I think it builds long-term trust that doesn't kind of burn the relationship. But in some cases, you also have to look at your cost of capital and the opportunity cost and think, is keeping my dollars with this manager today a good use of capital? Or is something like a secondary sale a better use of time and capital, right? And so in some cases, you can use tricks to actually even kind of redeem your capital sooner than maybe you would have expected or kind of otherwise would be able to. And those kind of situations were only reserved where, you had really kind of lost confidence in managers. But I think it's important to just be communicative with managers in general. And I've found that the managers with integrity and that are ethical, they appreciate that communication, even if the answer is not what they're ultimately looking for.
In the process of stack ranking all your managers, was it largely returns driven? So you were ranking hey, you know what, here's the consistency of returns across 5 funds seems to all hover around 5x, and that's why we were continuing to double down. This one, there's too much variability in their returns, and there's a 2x fund here, and then there's a 20x fund here, but it's just way too risky for us. or is it more so like industry focused, team building, like roughly? If you can leave it to speculation if you want, but like, how did you rank the managers? What was the rubric?
Yeah, I mean, naturally, a lot of performance had a big part in it, but there were also things like alignment with investment philosophy and alignment with broader endowment portfolio construction, and so things like more diversified portfolios or portfolios that started to look like indices would rank lower, even if their performance was higher. So we had a couple managers that had, I would call them almost like enhanced index strategies or like smart beta kind of strategies, where maybe they had really good performance and outperformed by their benchmark by a couple hundred basis points every year consistently. But because that didn't really add anything to our portfolio, something like that would have stack ranked much lower than maybe a concentrated portfolio that had maybe a little, maybe its performance wasn't as great, but it had a higher potential to generate outperformance over the long term.
Gotcha. So it sounds like, and don't let me know if I'm putting words in your mouth, that you want a concentrated portfolio of managers, and you were kind of also looking for managers who also had a concentrated portfolio, doubling down on the sectors that they firmly believed in.
Yeah, this was Scott's big approach at WashU, and I think part of the reason is, when you a lot of folks don't have the stomach to invest in a single manager that has a very single concentrated portfolio, but I think that's a trap to fall into, because when you think about it in a portfolio context, if we have 15 managers in our public equity sleeve, and each of them holds only 10 stocks, investing in one of those managers, the variability in returns is going to be high. But when you look at it in a basket, that's 150 positions across those 15 managers. That's a diversified portfolio, right? So even though each of those managers is concentrated, when you look at it in a portfolio setting, the risk is actually much more mitigated than you would think.
Gotcha. And speaking of this, I have asked this question to a couple like LPs, but I think not all of them come from the endowment perspective, which is when you're investing, let's say in that example, 15 managers, 10 portfolio companies each, how much are you looking at the underlying asset in the sense of, do you care if the underlying asset in the 150 companies overlap? So for example, if out of the 150 companies, you have a max of 10 companies, at least when you're looking from a top-down perspective, that should be overlapping.
So we did, Scott's philosophy was to spend a lot of time with the underlying portfolio. And so
Gotcha.
Not just underwriting the manager, but underwriting, and it was of course much easier to do with hedge funds and public equity managers where they had an existing portfolio. It's harder to do with venture funds where you're committing to a blind pool, of course. But on the public equity side, he cared a lot about what those managers owned. He would spend time underwriting those individual positions and form a view on them himself, because if he had a lot of conviction in maybe one of the bigger positions that a manager owned, he would want to go out and actually buy more of that position ourselves, so that WashU had an even more concentrated exposure. And Scott talked about this on another podcast actually, but I think being able to underwrite the portfolio yourself then gives you more conviction in the manager, but it also gives you more conviction to size up certain bets through SPVs or co-invest.
Out of curiosity, when you were at WashU, and I don't know if this varied because you did mention that Scott overturned like a third of the portfolio within like 5-6 months of him being part of WashU. But like, I guess the question here is, how did your team, or you and your team, think about like what percent goes into public, what percent goes into private, what percent goes into real estate, and all these kind of things? Were there buckets like general, like is it 1/3, 1/3, 1/3? Is it like 50-50 public to private? Like how is it done?
Yeah, and I know that WashU's evolved their thinking on this over the past few years, and so I can't necessarily speak to how they think about it today. But from an endowment perspective broadly, the first thing you're always solving for, there's two things you're solving for. You're solving for preserving purchasing power is number one. And so an endowment should be a perpetual pool of capital. And that means that in theory, it should exist forever, and you only ever spend the returns that you're generating. And so you preserve that principle. And so from a return standpoint, you need to construct a portfolio that meets your return goal. And generally spending for an endowment is 5% a year. And then when you layer on, call it educational inflation of 3%, and then ideally make a return on top of that. You need to have a portfolio that has the ability to generate at least 8%, hopefully higher on an annualized basis just to preserve purchasing power. And then hopefully you grow it. And so hopefully, you generate returns that are greater than that. And then the second piece is that spending, that 5% spending. And so you need to have sufficient liquidity in your portfolio to throw off, enough cash to pay out 5% to the school every year. And that's critical because if you have too big of an illiquid book, you don't want to have to sell your public portfolio, for example, when it's down, right? You don't have to crystallize those losses. And so having enough liquidity, whether it be through distributions you're getting from your private portfolio, or dividends you're getting from your public portfolio, or interest you're getting from your real estate portfolio, the asset allocation itself is less important, so long as those two things, the return goal and the liquidity, are kind of met each year.
Gotcha. This is fascinating to me. Switching gears a little bit over here, and this might truncate a lot of your experiences, but across Wash U to Edgehill to Bowdoin, I have a couple questions here. I'll start with one, which was seeded in my mind because before we clicked record on this conversation, I asked you, John, what hill are you willing to die on? And you're like, GP commits. And I was like, don't tell me anymore. I want to save it for the podcast itself. But could you share a little bit more about what did you mean by GP commits, and in your mind, most people see GP commits as a way of the GP to align themselves with the incentives of the fund, but why that might be a folly in some ways.
Yeah, so I think a lot of LPs use GP commit. You said it exactly right, as a proxy for alignment, and I think that's a really lazy heuristic to use because I think it's much more nuanced than that. And so, a lot of LPs the industry standard has kind of become this 2% number is generally an acceptable GP commit. And if you see that for a lot of LPs, it's like a check the box type thing, right? They had 2%, great, alignment. But I think that's silly for a couple reasons. And I'll give you kind of both examples in both directions. So for a new emerging manager that's maybe raising their first time fund, maybe it's somebody who's young and they haven't had a meaningful wealth creation, event yet. And maybe they can't do a 2-commit GP commit, or 2%. Maybe they can only commit 0.5% or 1%, or some nominal, dollar value. So a lot of LPs would look at that and say, you know what, that's a low GP commit. I can't do it. There's no alignment there. For me, I would look at that and I would try to understand, okay, why are you not able to make, a high GP commit? Maybe it's because, to my earlier point, you haven't had a wealth creation event yet. And then I would look at that manager and I would say, actually, there's really strong alignment here because they're not, they're raising a small fund. They're not making a lot of money on fees. And they're really playing for carry because they have, they're not fat and happy yet. They don't have a lot of money in their pocket, right? And so I think it's silly to discount that manager just because they don't have the capital to make a GP commit yet. On the flip side of things, a lot of really big firms and these big multi-stage platform firms have GP commits that are much lower than they should be. And maybe it's that 2% number and they just do 2% because they know they can get away with it. And but these are firms where the partners are worth tens, sometimes hundreds of millions of dollars. Sometimes, sometimes some of these partners are billionaires, right? And if they think that the investment product they're offering to their LPs is the best investment product out there, why wouldn't they want to put a lot of their money in it? Why wouldn't they want to put a lot more of their money in it? Why wouldn't they want to do a 5 or a 10% GP commit? And by the way, some big funds that we see do have really meaningful GP commits that are 5%, sometimes 10%. It's very, very uncommon. And it still baffles me that some of these bigger, multi-stage platform firms just do the token 2%. I mean, I just don't get it. If they really believe in themselves and they think that they see great deals and can generate great returns, you have the money, do 5%, do 10%. So I think it's just lazy heuristic a lot of GPs use, and they don't leave room for nuance. And I think there is a lot of nuance in it.
I guess I don't know if this is a public number per se, but I'll just kind of for example, Vinod Khosla at Khosla Ventures puts a meaningful, very, very meaningful double-digit percentage and I think to this day, I think they're the largest. He's the largest LP of his own fund, kind of thing, right?
Mm-hmm.
Yeah. So that's an example of extreme alignment, and obviously Vinod has done very well for himself over the decades.
Yeah. And by the way, that's a great signal. That's like a super positive signal. That's somebody who has a lot of capital, but is investing his capital in his own product, which I think is like the best signal of alignment.
Oh yeah, 100%. So it sounds like, and just to kind of like summarize some of this, it sounds like not only is GP commit, like you should never measure any variable singularly by itself. It should never be isolated, right? And so in this theme of GP commits and alignment, you should be looking at GP commits as well as management fees as a function of the fund size and where they are in their own life, like wealth creation events and all that. But it sounds like, I mean, so an example of misalignment per se would be very low, let's say 0.5%, 1% GP commit for a $500 million fund one, where even though, let's say that GP is not independently wealthy, is going to make a lot of money on management fees.
In that case, just do like a management fee offset and increase your GP commit, right?
Right. And we've actually seen a lot of emerging managers these days for their fund ones, be it like $5 million, be it $10 million. They end up putting a lot of the management fees as their version of the GP commit back into the fund. So that's an option as well.
Yeah.
So speaking of learnings across, and I kind of want to open this up a little bit more, but are there other things you've learned kind of like across WashU to Edgehill to Bowdoin to obviously now you're at Allocate with the legendary Matt Cutolo and as well as Hannah and Samir on the Allocate team. But how has your approach in working with emerging managers changed over the course of your career so far?
It's a really good question. And I would say in the beginning of my career, when I was first learning about venture, you first learn about the storied venture firms that are the big brand, the Sequoias of the world, the Kleiner Perkins of the world. And I think in the beginning, I thought venture was kind of an all or nothing game where like, if you're not in those firms, you shouldn't do it, right? Of course, at one point that was true, but I think we all can agree like that's not true anymore, right? It took me a while to evolve that thinking. And then I'd say the layer deeper was like the endowment world, and a lot of endowments have really strong venture portfolios, but I think a lot of the frameworks that a lot of these endowments use to evaluate managers have become outdated. And a lot of them have artificial parameters around things like we need to see a track record, or we don't invest in solo GPs, or we don't invest in this or that. And it's very black and white. And what I've learned from now meeting with probably well over 1,000 venture managers over the course of my career is there are a lot of ways to win. There's a lot of ways to lose money too, by the way, probably even more ways to lose money, but there are also a lot of ways to win. and like things that might look different and things that might not jive with that kind of traditional or with those traditional frameworks doesn't mean they're bad managers and bad investments. And in fact, some of them can do really, really, really well. Right. And I think when you look at something like Oren Zev, right? Oren Zev is literally one person. He doesn't have a team. He raises a fund pretty much every year, and he invests in whatever he wants to. No, it's going to be almost impossible for any endowment to underwrite something like that. And I think he does have one or two endowments as an LP, but those are very forward-thinking endowments. Most endowments would look at something like that and be like, "Oh man, too much. There's a lot of key man risk. Like he's one guy. Like he doesn't have cohesive this or that." I've gotten the time, taken the time to get to know Oren really well. And if you spend the time, you can realize that he has a very, very clear investment strategy and a very, very clear way of thinking about the world. And I think what I've learned over the years is that like, just because something looks different doesn't make it bad. And just because something challenges an assumption that you previously held doesn't mean that your assumption is right or wrong. But it means that you have to challenge that assumption and you have to see if that new piece of information maybe is right. And so I think being too dogmatic about things or having too, black or white views, I think will prohibit a lot of LPs from making really, really good investments.
I hear you. I actually want to double click on something you mentioned, which is the key man risk. For those with the untrained ear, could you define what key man risk is?
Yeah. So key man risk is effectively, when you're investing, and I'll speak about it in the context of a manager, but when you're investing in a manager, if there's one single person who, your investment thesis really revolves around them being a contributing member to the firm and to the strategy, And if that person were to no longer be involved, or if they were to die or leave the firm, your investment thesis would materially change. So that's key man risk, and it looks very different. I mean, you could invest in a firm that has a 10-member team, but maybe there's one person who's really the rainmaker, and if that one person leaves, then that's key man risk. Or in the case of a solo GP, there's of course key man risk because they're the only person, right?
Yeah.
So you have to key man risk is not something that you can't there's always going to be some degree of key man risk, but I think you just have to think about what happens if this person leaves. I think people overblow the solo GP key man risk because in most cases, if the solo GP dies or gets hit by a bus, like you have a portfolio already, like nobody's going to be there's nobody to continue making new investments. And so like the worst risk that you have is that like whoever takes over management is going to somehow like mismanage the exits, but exits are kind of a lot of times outside your control anyway. And so I think key man risk is something that you have to, of course, look at, but again, a lot of nuance and thought behind it.
There's so much that's up in there, and it's not often they actually have opportunities to exit. And it often only happens to a very, very small percentage of one's portfolio.
Yep.
And that's why you can book into DPIs and all that. There's obviously secondaries, and I think a lot more funds are playing with secondaries these days. But I think realistically, to get the most bang for your buck, so to speak, it really is on liquidation event, either M&A, IPO, that kind of stuff.
Yeah, exactly.
Unless you don't have signaling risk. There are also, if you're a pre-seed fund and you're selling at maybe like Series D 30% or so, right? Like you're probably not going to get too much signaling risk in that sense. Very interesting. Speaking of emerging managers and just like empathizing with them and understanding them, one of the things that kind of like I found and I think we also mentioned this in our previous conversations offline as well, which is like, you obviously spend a lot of time with emerging managers. And John, I'm curious, you also have a fiance, Olivia, who is a founder. And so in having a fiance that's a founder, does it help you better appreciate and empathize with the scrappiness of people starting something new, be it founders or emerging managers?
So absolutely, yes. And there's a couple of ways actually in which seeing Olivia start her company, raise capital from investors. There's a couple of ways in which that's influenced or even challenged some of the beliefs that I previously held. And so I'll give you a couple examples. As an LP, you kind of sit on the periphery of the VC founder interaction, right? You do references on your VCs when you're diligencing them, but let's be honest, it's rare that you're going to get a really bad reference on a VC, right? And so, of course, you have to be, kind of good about the questions you ask to try to read between the lines, but it's rare you're going to get a completely unfiltered view unless you're doing a reference with a, friend or somebody close. And so I think seeing her go through the fundraising process firsthand, getting her completely unfiltered view on not only individual managers, but just on what the process is like in general, like what VCs care about at the earliest of stages, did not always align with, maybe some of the beliefs that I previously held, right, from my almost periphery standpoint. And so I think it's been really interesting to see that. It for sure has given me a greater appreciation for scrappiness, required to start something new, whether it be a company or a firm. I mean, there's just so much you have to do outside of your core responsibilities. And so, this is actually one thing we talk to first-time fund managers a lot about. When you're starting your firm, investing is only one thing that you're going to be doing. And I think it's almost counterintuitive, but a lot of the folks that have the biggest challenge starting a new firm are the folks that have been longtime GPs at existing, multi-stage firms. Because when you're a GP at one of those firms, it's been around for a while, that have big teams, they have individuals to focus on every specific vertical, like fundraising and operations and finance and accounting. And so you don't have to do any of that. You can pretty much just invest. But when one of those people leaves to start their own firm, now they have to do all that stuff. They have to build a firm. They have to do hire somebody for accounting. They have to do the fundraising. They have to do the reporting. And so I think like seeing how much other stuff you always have to do as a founder, whether it be a founder of a firm or of a company, gives me a much greater appreciation for how hard it is to then execute at a high level on whatever your core mission is.
I love it. Speaking of the world of diligence and reference checks and all that, this is a question, like, I'll be honest, both of us have been very excited about. I think too often when it comes to, there's two angles of this, right? There's some investors that just don't do enough diligence, and there's some LPs that just don't do enough diligence. They go like, hey, I like this person, let's go invest, right? Don't even consider the key man risk and all these other things. And there's the other side of LPs out there who they want to cover every corner of the sofa, right? They effectively want to have the equivalent of I don't know if this is the right analogy, but a panopticon. You know, those circular prisons where there's like a guard tower in the center. You could see everyone effectively. They want to have that. But the truth is, in the world of private markets, you can't have that. And so I kind of want to talk about this Rubik's Cube of diligence, so to speak, right? And so one thing I'm really curious on your end is, how do you personally balance the act of over diligencing and under diligencing emerging managers? Because it's very much of this tightrope. And oftentimes, who knows if it's too much? Who knows if it's too little?
It's a really good question. And this is something that it's really tough, and it varies from manager to manager. And I think there's a couple of ways we think about it at a high level, and then I'll maybe go into some of the more specifics. But with every manager that we're diligencing, we try to, from the outset, or at least after we kind of do a cursory look, we try to identify, like, what are the 3 to 5 biggest questions we have here that are going to drive our ability to make a decision by 90%, right? And focusing on those 3 to 5 things that matter more than anything else. If you answer those 3 to 5 questions, you can get to a pretty high probability of conviction on whatever your decision is. Now, there are always things that you're not going to be able to answer in diligence. Some of those questions are important. Some of them are not important. I think the biggest the biggest leverage on time that you can get is identifying which questions are the need to haves versus the nice to haves, and knowing when enough work is enough. For somebody like me who's really intellectually curious, and like, if I could spend the rest of my life doing diligence on one single manager and still have more questions to ask, right? But you just can't do that, and it's not a good return on time. And so I think, it's a skill to know when enough is enough. And there's never a clear answer. And maybe what's enough for me is not enough for you. But as a team, we have to be able to get to that decision, know when enough is enough, know which questions we might never be able to answer, by the way. And I think that's also something that requires self-awareness and introspection, is knowing, like, hey, this is a question that's outstanding. I don't think we're ever going to be able to answer this. Are we comfortable making a decision or not? And if the answer is no, then you can't move forward. But if the answer is yes, then that's okay. You're comfortable that you won't have an answer to that question. And so there are non-negotiables, and then there are things that are negotiable, and that, like, where, hey, we don't have an answer, but that's okay, and we can still get comfortable. But it's really hard to know when that's right. It depends for every manager, right? And some of those questions, by the way, might be non-negotiable for one manager, but it might be okay for another manager. Right. So it's really all about context.
I'm curious for you, and not to limit the scope too much here, but what are your non-negotiables?
Yeah, it's a really good question. So the first thing I think about when looking at emerging managers is, what is your reason for existing? Do you have a right to exist? There are literally thousands of venture managers out there today, and every year there's hundreds of new funds that get launched. The world doesn't need another venture manager. In fact, I would maybe argue the world needs fewer venture managers. But that doesn't mean that new managers don't have a right to exist. And so the way I think about it is, like, what are you doing differently or better than every other firm out there that gives you a reason and a right to exist? And so that's the first one. It has to be crystal clear why you deserve to exist. And what I mean by, like, deserve to exist is, do you have a reason why you're going to be able to, source, pick, or win better than everyone else, right? And generate good performance. So reason to exist is a good one. The other non-negotiable is, you need to have a really long-term outlook on what you're building. And I always ask the question, like, what's your firm vision? What do you want this to look like? I intentionally try to leave that question vague to see how managers answer it. And if their first response is like, oh, well, this first fund's 50 million, and I want my second fund to be 75 million, and I'll hire an associate, and then they stop there, like, that's a red flag because they're only thinking about their next fund.
Right.
If they answer with something like, oh, well, 20 years from now, I want this to still look like a cottage firm and I want it to be the three of us and we're an equal team and like the fund size is like this and maybe it's increased, at the same rate of seed round inflation, but that's it. And, I want, and they're thinking they're thinking literally in decades rather than months or years. That's a really positive signal. And so like, that's a non-negotiable. Look, one fund, venture funds are structured as 10-year funds, but they're especially in the early stage, they're not 10-year funds. Yeah. They're 15-year funds, sometimes longer. And so if you're not thinking in decades, you're going to lose. You're already going to lose. That's a non-negotiable. And then I think the other one, the last one that's kind of a non-negotiable, and this is goes hand in hand with the reason to exist, but is you have to have an edge, and you have to have an edge that you can articulate. And your edge cannot be something like, oh, well, we have operating backgrounds. Like that's not an edge. That's a feature. And that's something that might help you, but hundreds of venture firm partners have operating backgrounds. Right. It's like, no, tell me why that gave you a unique insight or a unique sourcing channel or a unique ability to pick or help. And if a manager can't articulate something that's like a true edge, then if they can't even articulate it from themselves, I'm like, how am I ever going to figure out why these guys are going to make money?
Speaking of edges and speaking of things that are unique and saying that you have an operating background are there traits that managers come to you and they say that they think are unique, but are actually not unique because you've seen so many? So an example would be like, having an operating background or being a previous founder may not be the most unique thing. But are there other examples of things just so managers can escape their own myopia of I'm the most special person in the world?
It's a lot of like the speaking in generalities. Okay. Like, oh, like it's those things. I have an operating background. It's like, okay, great. Well, so does everyone else. Like, tell me why yours is unique. Or I have a great network. Okay, well, that shouldn't necessarily be an edge. By the way, it could be an edge if you have like a unique network.
Right.
But just saying like, I have this big network. No, it should be table stakes to have a big network if you're starting a VC firm, right? And so I think it's these people who like don't have anything else to grasp onto that's like super tangible or a differentiator. They fall back on these things that like in theory sound nice, but they're like table stakes things, or they're like not truly differentiators. And so, and by the way, not to say that like having an operational background is bad. Like no, it could be super helpful, but it's not necessarily different. Like, tell me what actually is different.
Yeah.
Or better. By the way, you don't have to be different just for the sake of being different. Like maybe you just found a way to do something like 10 times better than every other firm out there. Or maybe you found a way to source 10 times, better. Or maybe you figured out a way to analyze founders 10 times better than everyone else out there. These are just like things I'm making up.
Although
like,
almost
tell me about them.
Definition, if you're 10x better than the next person, you're probably doing something different.
Yeah, no, it's true. It's a really good point.
I also think like it's easier to like explain different than to explain better. Like if you say like, I'm 10% better, 2x better, 3x better, like as an LP with very limited data points, there's very little to go on there.
Yeah, it's true. And I think LPs like differentiation because, and they like when people talk about differentiation because it gives them a reason for doing something.
100%. I really like this line. I think it's a tweet, which we can pull up if people are watching on video, which is, I think it's by Chris Pike at Pace Capital. And I think the tweet is something along the lines of, we invest in things that cannot be described by a single sentence, which to me is very interesting, but it's on the frontier side of things. But it like to cross use that in the world of LPs and GPs, you effectively want to invest. Well, I mean, okay, I don't want to put words in people's mouths, but it's interesting enough to be able to invest into funds that cannot be described by a single word or 2-3 words, right? Like having a network, having an operational background. Those generalizations are just one in a million. Versus if you have to spend extra verbiage to really describe why you're very specific, not to get too verbose. Like I don't want to confuse this with, let me just describe what I could say in like 5 words with 2,000 sentences. But there's something special about that.
I think, so it's a really interesting point. And I think there's parts of it I agree with, and there's parts of it that I would maybe challenge, which are like,
challenge me.
like, look, if you're, of course, there's some of the most interesting, opportunities for investment, especially in like deeply technical areas, are complicated. Like they can't be, explained in one sentence. But I'd say the flip side of that is like, if you cannot explain something in a concise and almost like a beautifully concise way, then maybe you don't understand it yourself, right?
Yeah.
And so now, sometimes it can be hard to describe something in one sentence or two sentences, but like for us, it's kind of the investment memo that's the forcing mechanism for us to be able to put our thoughts on paper. Like if we can't write our thesis, for a manager, or write like why we have conviction for this manager in a straightforward and relatively concise way, then like maybe we don't truly understand what our own thesis is, or why we really have conviction. And so I think there's a balance between, you're right, like not being too simple, where there's no differentiation or nothing to grasp onto, but also still being able to communicate something in a straightforward and concise way that kind of lends to your understanding.
100%. I also would like to remind people listening to this that unless you're talking to an individual LP, which even like as an individual LP, there's still this thing, but like if you're pitching to LPs, most of the times it's a game of telephone. And what you're telling, for example, John, he has to translate to his team, or what you're telling me, even as an individual LP, I do the fact check of like, I tell my partners like, hey, does this make sense to you? Like, she's not an inventor at all, but if it makes sense to her, then it's like, okay, I've correctly understood it. And I kind of like bring this back to the managers, like, am I right in understanding this? Or am I completely off the mark there? Because if I'm completely off the mark, then there's another understanding issue, right? But because it's a game of telephone, if you become too long-winded and too verbose, you'll lose people in the sauce.
Yeah, it's true. And I think, going hand in hand with that is also like understanding who the final decision maker is. And I think as an emerging manager, to your point, David, like oftentimes the person that you're pitching on your call might not actually be the final decision maker, right? And so understanding like their governance structure and like how decisions get made is critical. And I think as a manager, you should adapt how you tell your story depending on like how that decision-making framework works.
100%. I mean, at some point you might just have a Scott in an endowment saying like, hey, we're going to stack rank everyone. And so there's another layer of translation, because it's like the team decision, but also on top of the team decision, it's like you're waiting X number of months, years later to effectively stack rank everyone. And they still have to remember it despite all the layers of atrophy that appear after talking to so many other managers out there.
Yeah, and there's always a recency bias, and like,
oh yeah,
it's funny because like you're talking about like how conviction or how your thesis atrophies over time. It's kind of just like when anybody asks me like, oh, what are your favorite emerging managers? It always goes to like the couple that I've met recently, right? And like that's no fault of my own. I think it's just like there's always this recency bias in how people think about things, and so finding a way to stay top of mind over a longer period of time is really something special that some of the best managers can do. Okay,
so as we're coming up in the back half here, because John, you and I can talk forever. And the last time we had coffee, we literally talked forever. So, we can. And so I want to round up with like two questions over here. One, as we were kind of preparing for this conversation, one thing that stood out to me, and also like I know you publicly talked about like cold emailing your way into Allocate as well, but you are a wizard with cold emails. And even if no one else believes that, like just the number of individuals that you've been able to build friendships and build opportunities with goes a long way. So as someone who's cold emailed their way into a friendship with Mark Andreessen, Dick Costolo, to Ron Conway, just to name a few, and who has spent the better half of your career in an industry that's widely known or notoriously known for being cold email averse, what are the mechanics to a well-written cold email?
It's a great question. And I guess the first thing I'll humbly say is like, I didn't necessarily cold email my way into a friendship with all those folks, but I cold emailed my way into, an interaction or getting on the phone with some of those folks. And some of them, it did turn into a friendship, but I think a lot of people are afraid of using a cold email because they're afraid of rejection. I mean, that's just like a common fear that a lot of people have. I also think a lot of people approach the cold email the wrong way. They approach it from in a very lazy way, right? Like, I need something from you, please help me. The way you have to approach a cold email, or at least the way that I've approached it and used it, is like, here's what I can do for you, with also a healthy dose of like stroking the person's ego. And I think that's really critical because, look, at the end of the day, like when you're cold emailing someone, you're probably cold emailing someone that's really busy and who has, a lot of other things going on. And so like you need to give them a reason to make time for you, right? Who like they generally don't have a reason to make time for you. And so you have to give them a reason to make time for you. And that reason sometimes might just be like, hey, this person did their research and like they had the, gumption to reach out to me. And so I'm going to give them a call. Like that's a good enough reason sometimes. And so for me, I'll always try to get a warm email or a warm intro into somebody. But like if I can't, I have no qualms about using a cold email. And you mentioned it before, like early on in my career, I think 2 years out of college, I cold emailed Mark Andreessen to do a reference on another manager, and he called me later that day. And so like, if you frame the same thing with Ron Conway, like Ron Conway, called me later that day. The other thing about the cold email is you have to make yourself available immediately because like I always include my cell and I'm always like, I can talk now or just give me a call. Like you can't if you try to schedule something with somebody that busy, you've already lost. Like you just have to be available. You have to pick up the phone. I used the cold email more earlier on in my career. As my network's expanded, it's like the need to use a cold email has gone down because I have warmer introductions to most people now, but I'm still not averse to using it. And you're right. It's how I got my job at Allocate. I cold emailed Samir after seeing a tweet of his that he was hiring and it worked out. And so I think a lot of people are afraid of that rejection or they're too lazy to like put in the work to write a good cold email, but it can work. And I've had a good success rate.
I will also say that it is a muscle that is very useful to use even if you have the network. And I mean, let's say between you and I, we're probably well connected in the kind of the venture ecosystem, and we could probably find a warm intro to anyone we'd possibly want to meet, whether founder, investor, LP, or otherwise. But there's a whole world out there that we have no access to, whether it comes to like Hollywood. Like, do I have that much? Yeah. I don't have any connections in Hollywood. Maybe a few, but like not that many, right? And so I still have to cold email my way to like find people and talk to people I deeply respect. And that exercise of doing so helps me become a better thought partner when a manager is cold emailing someone, an LP, or like, a founder's cold emailing a client or a potential customer, a potential VC. And so helpful in many different wavelengths.
It's a shame that people have such a visceral reaction to like the concept of cold emailing sometimes. And I think that's just like, I think it's lazy. I think it's lazy that people say, oh, I would never do that. Like,
I will also be honest.
It's the worst thing that happens.
It is, speaking as an introvert, it is very scary. Like,
oh yeah,
the thought of getting rejected. I will say after, this varies for every single individual, but after sending about like 40, 50 cold emails, it kind of gets better over time. Is it still scary at times? Yes, it is. Right. But that's just the human part of it. Like, if there is someone who truly thinks that cold emails to people you deeply respect are no longer scary or frightening, or you don't get nerves from it, like I'd love to talk to them because I haven't conquered that, but I still do.
Yeah. And I still totally get nerves when I email people like this. And I probably reread the email, 100 times to make sure I don't have a typo in it but I think when you realize that like the worst thing that happens is they don't respond or they do respond and they say like, sorry, I can't talk. Like, whatever, you move on. Right. Yeah. And the best thing that happens is they respond and they get on a call with you and they're really helpful. And it's a new connection that you have forever.
Yeah. The downside risk is just like nominal. Like like you get a no response. That's the worst thing that can happen. Okay. Yeah. Man, I want to ask you a bunch of more questions, but I'll round out with this conversation with one more. John, I know you're a diehard sports fan, and I'm curious if the highs or lows hit harder for you. So between the Eagles trumping the Giants last year only to have the Empire State Building bleed green and white, or Shesty coming in clutch in overtime against the Pittsburgh Penguins in the tightest 4-3 match the world may have ever seen, which one hits home like no other?
Oh, you did your research. So I will say when that Empire State Building, when it was green and white, that hurt. That was brutal. And it's timely that you're asking this question because the Giants just we just lost Saquon Barkley, our star running back, to the Eagles.
Yeah. And
so for me, I love the wins, but as a New York sports fan, it's been a while since we've had a big win, and so I think the losses hit harder, especially like. The Rangers made it to the Stanley Cup, not the finals, but they made it to the semifinals 2 years ago. And it was an amazing postseason. They played really well. And then that series, like in the semifinals, they just kind of like looked sluggish and they lost, and it was really a bummer. And when you end a season on a low note like that, you have like the whole postseason to like be depressed and to like think about how bad the season went. And then when the season finally picks up again, you're like, okay, great, it's a new season, but like now we have to like play super well and like, build back momentum. And so for me, I think the lows sting more than the high. I mean, like the highs are great. Of course, like when a team wins, the Super Bowl, which I've been fortunate enough to see 2 giant Super Bowls in my lifetime, or when the Yankees win the World Series, which they haven't done in 15 years. But, when those things happen, they're amazing. But the shine and kind of the glow, it does wear off, kind of quickly. And so I don't know. And for competitive people, like you win, you move on, and you're always like, all right, now let's do it again. Right. And so I think for somebody who's competitive like me, like, man, those losses really, really sting. Seeing the Empire State Building in green and white, that sucked.
It's for the whole world to see. It's not just like a private set of remorses. It's like the whole world there's a half that's cheering, there's a half that's not cheering, and finding themselves in a small room, or eating ice cream, which usually tends to be my snack of choice. All right, John, we're in the back half here. I don't want to take too much more of your time. This has been thoroughly enjoyable. I've enjoyed every second of this. And I know you're in quite a few places. You're on Twitter, you're on LinkedIn, you obviously have an email out there. But if people were to pick one place, whether it's LPs looking to dive deeper in conversation with you, or GPs trying to understand a little bit more about your kind of thesis betting on emerging managers, where's the best place for people to find you?
Folks can find me on LinkedIn, or you can email me, john@allocate.co. I'm not super active on Twitter. I
used to be.
I go on Twitter. I read stuff on Twitter, but I have a theory that the more time that VCs spend on Twitter, the worse their returns are. I have not tested out that theory yet. That's just a theory that I have in my head. But
I'd love to start tracking that data at this point. Now that you mention it.
But yeah, shoot me an email, find me on LinkedIn, add me on Twitter, any of the above are fine. But always looking to connect with more folks and happy to chat about anything.
Amazing. Well, thank you so much. And we'll see each other soon.
Thanks, David. Really, really enjoyed the chat. You did your research. So
I want to give a special shout out to today's sponsor, Alchemist Accelerator. Backed by the likes of Khosla Ventures, Mayfield, Salesforce, just to name a few, Alchemist is the top B2B startup accelerator that's been around since 2012, backing founders from day one. And if you've been around for 12 years and running laser focused only on one industry, you build this incredible set of flywheels, and positive feedback loop is absolutely insane. We back the best enterprise talent who go on to change the world in which we live in, who then come back to their hometown, coach, and mentor the next generation of world-class enterprise talent. And don't take it just from me. Alchemist has backed the likes of LaunchDarkly, Rigetti, Privacera, MoEngage, FarmWise, just to name a few, many of which who have come back as mentors and coaches for the current classes of Alchemist. If you're curious and want to get more involved in the Alchemist ecosystem, check out alchemistaccelerator.com/superclusters. That's an S at the beginning and S at the end, and we'll include the link in the show notes below. Till next, stay awesome. Hey Superclusters fans, David from Post here, and if you're tuning in from Spotify, Apple Podcasts, or wherever podcasts find your ear, it'd mean the world to me if you left a review. For those from the YouTube universe, let me know if you agree or disagree in the comments, and it'd mean a lot to me if you could share this episode with just one other person who'd get a kick out of today's topics. I'm on the road to publishing to at least 100 episodes of Superclusters, so every comment, question, review helps me make this experience more helpful, exciting, and fun for you. And lastly, I want to share a quick disclaimer. The views expressed in this episode are for informational purposes only and are solely the views of myself and the guest alone. They are not representative of Alchemist Accelerator. None of the views expressed herein constitute legal, investment, business, or tax advice. Any allusions or references to funds or companies are for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor prior to making any investment decisions. And that's all from me. See you on the next.